real quick. Let me see something fine. All right, you guys ready?
We're ready.
Get this show on the road. Welcome to Wall Street Beats, everybody. I'm Steve Lamar. I'm joined by our banking and financials pro, Charlie Peabody, who is back from a week straight of 18-hour days going through bank earnings. I think he looks well rested and ready to go. And then we've got I don't even know what to say about this outfit from Robert Marson, but Robert is our growth and value pro. I bet he's got something to say about the Philadelphia Flyers, but I don't know. Maybe there's a stock idea in there behind that outfit. All right, let's get this show started. Let's start with Charlie, who I bet could give us a real quick recap on all the bank earnings if he's so inclined. But I know he wants to talk about an idea with another big bank that's been on his list. So let's hear it, Charlie.
Sure. Earnings season for the big banks is concluded. It was very robust. The formula was, to create, high teens EPS growth from high single-digit revenue growth through positive operating leverage, benign credit quality, and mid single-digit share buybacks. And that was the formula. Played out that way in the first quarter, and probably would play out that way again in the second quarter. So pretty healthy earnings. But there's one observation I want to make. So the S&P has been hitting new highs. And these large cap bank stocks have not. The one that has obviously hit new 52-week highs is Citigroup, which is our number one money center pick. But the others haven't, and the XLF hasn't. It's been lagging. And that's kind of interesting to me because if these things can't push to new highs, and we'll see this week whether they can or cannot, it doesn't bode well for the overall market because bank stocks and financials are a big part of the S&P. So I think you have to watch that closely. I mean, obviously this rally is not over with, so the banks could, pick up, the pace here. But the one name that I want to highlight.
Charlie, what do you think before you move on? What do you think the market is missing in these numbers? You've talked about this being kind of an earnings trap here with the stock's reactions, kind of post earnings. Can you unpeel that a little bit further for us?
Sure. The best correlation that I have found over history with stock performance in terms of earnings, metrics or dynamics, has been what we call PPNR, pre-tax, pre-provision net revenues. That basically is total revenues minus expenses, but it does not include credit costs. And so total revenues minus expenses, that's PPNR, pre-tax, pre-provision net revenues. That was up about 16% here in the first quarter, which was very healthy. But when I look at my models and in the next three quarters, first quarter looks like it's going to be the peak momentum. And as I said, that tends to be a good coincident indicator with the stocks. When that peaks, the stocks peak. So the second quarter is shaping up to be up about 11 or 12%. Third quarter drops to like 7%, and the fourth quarter to 5 or 6%, and then it drops into 2027. And then the question is, if you're losing your revenue versus expense momentum at a time when credit costs might be rising because there's a corporate credit cycle that's starting to show deterioration, then these things definitely have peaked. Now the question is that corporate credit cycle going to get worse? And that remains to be seen. But the risk rewards are starting to become less attractive given how highly valued these stocks are. I mean, they're trading at 2.5, 3 times tangible book. So I don't like them here, quite honestly.
What kind of downside could you see from these, Charlie? Like 10, 20%?
Oh, I think you could see 20% for sure. A lot's going to depend on the credit cycle, and the
Right.
Jury's out on that. I mean, we're seeing some deterioration, but it's not broad-based enough to hurt the earnings of these banks. By and large, the first quarter earnings dynamics were good because credit quality was benign. Now there's some underlying issues there, and I'll get into that as I go through the slides here. So why don't I do that, Steve, and
Okay. All right.
you can ask some broader implications. So this is earnings for the first quarter. What I'm going to do here is highlight Wells Fargo because I think that was the weakest report of the earnings season and the stock that should be sold if you're performance oriented. Wells is a name that I've liked, for many years. I sort of got off the bandwagon last year, a little bit maybe prematurely, but I think it's got a lot of downside risk. And if you're an aggressive trader, it's one I would actually short here around 82 and change. But what you can see from this slide is that they missed earnings expectations. They were one of the few to miss earnings expectations. Their earnings came in, mid-single digit, type of numbers. I mean, I'm sorry, low double-digit type of numbers, which was below the street. It's considered healthy, but the S&P is growing 15 or 16%. Banks are growing 20+%, and they grow 12%. That's relative weakness. So, the bottom line was not attractive, and they missed on some dynamics, and that's what I'm going to go into next. So let's look at the next slide, Jen, which should be.
So Charlie, revenue. They really couldn't find a penny.
They could not find a penny. Yeah. So, the banks do have fairly good control over what they want to report. So yes. The fact that they missed slightly is not a good indication.
That was a signal. Yeah, for sure.
Yeah. And here, this is the revenues for the first quarter. The salmon colored column is the expectations versus the actuals. And you can see that they missed on revenue expectations. And the revenues came in, roughly, I can't even see without my glasses, 6.5%. Again, that was weak relative to the 10% growth that you're seeing in the industry. So again, a little bit of a disappointment. And by the way, their revenue growth should decelerate in the ensuing quarters from that 6.5% rate. So, again, not going in the right direction. And let's go to the next slide. All right, so this is net interest income. The salmon colored columns on the right-hand side are the first quarter actuals versus estimates. And they missed their expectations on NII. NII is net interest income, spread income, top line revenues, whatever you want to call it. And it is the one revenue source that people pay a high multiple on. So if you miss, it's usually doesn't help your multiple. And they were one of 3 banks that missed during the first quarter. Everyone else beat expectations. So that's a knock against their ability to get a higher multiple. If we go to the next slide, this is deposits. The salmon colored column is the rate being paid on deposits by these major banks. You can see Steve and Robert, you're not getting paid anything for your deposits right now. No. But Wells Fargo literally is paying the lowest rates on deposits. So it's hard to see how their margins are going to expand relative to the industry, given how little they're paying for deposits right now. And that's important because that's where their net interest income is falling short, is on what we call the NIM, net interest margin. The margin is falling short of expectations. So they're getting squeezed on their spreads. Let's go to the next slide. This is capital markets revenues. The top is total capital markets revenues. The middle chart is trading revenues, and the bottom chart is investment banking revenues. Wells Fargo is making a big push in this area. They've literally doubled their trading book over the last 12 months now that the cap on their assets has been removed by the regulators. But they're falling, they're still way behind, the big banks in terms of their ability to generate, strong trading revenues. That's that green line in the middle table. And you can see their growth in trading revenues is not as robust as what you're seeing out of other money center banks. And the same with the, investment banking revenues, which is that bottom green line. Again, they're way, below what the major banks are producing, and their growth is not as strong. And capital markets has been a robust area. So they're not able to generate as much revenue and as much growth. So let's go to the next slide.
Have those ever been seen as opportunities for them?
It is an opportunity. I mean, they are gaining share, absolutely gaining share. But this quarter was the first quarter where they didn't show share gains.
Right.
So that's interesting.
That's
They've
not
been growing
right.
slower than the industry. But in the last year, they've been growing much faster than the industry and gaining share. So they do see it as an opportunity. Good observation, Steve. All right, what we have here, let me read, is wealth management. Okay, wealth management, as you can imagine, with the markets making new highs, is a very robust business. The salmon colored columns on the left-hand side are the actual revenues versus estimated revenues. And you can see they fell short. This is a high margin business for most banks. If you look over to the very right, you can see their margins are below industry average. Again, one could view that as an opportunity to improve, but with markets near all-time highs, and they're not there yet, they may be facing headwinds. So again, a slightly disappointing quarter on the wealth management side for them. I will point out the banking industry tends to price their wealth management assets either on April 1st or with a 1 month lag, which means in the first quarter, it did not include the month of March. So March is going to be reflected in the second quarter. So as you know, April 1st, values were much lower than January 1st values, and March gets put into the second quarter, which was a weak month. So the second quarter is probably going to be weaker than the first quarter for wealth management. All right, let's move on because I've got a lot of slides here, and I'll just try and keep this short. Oh, this is important. So
You're
if
just
there
showing off,
is,
Charlie. You're just showing off how busy you were the last week.
I was very busy putting all these numbers in. So this is corporate and industrial non-performing assets. These are the problem assets in the corporate loan portfolio that do not include commercial real estate. Actually, commercial real estate is somewhat improving, which is why I like Flagstar, FLG. But this shows, your basic manufacturing, widget producers, etc. And what we've now seen is 6 quarters in a row for this industry of higher commercial and industrial non-performing assets. All right, so it does not include any real estate. It's just basic, corporate business. And Wells Fargo has seen in the last 2 quarters big jumps in their C&I portfolio. So they're seeing a greater deterioration than the industry, but the overall industry is seeing their corporate non-performance inch up. I want to caution the increase are such off of such low levels that the banks can absorb it and they're well reserved for it. So it hasn't disturbed their P&Ls yet. But as they say, things start one by one or gradually, and then all of a sudden happen all at once. And that's what I'm looking for is the number, the 1 or 2 cockroaches we're seeing all of a sudden become a cluster of cockroaches.
Right. Yeah.
Next slide, and I'm getting close to the end here. Jen is, this just shows Wells Fargo's exposure to what we call NDFIs. Those are the non-bank financial institutions. It's gotten a lot of visibility in the last month and a half as a potential problem area for the industry. Wells Fargo, if you look at the very left-hand column, has $210 billion of exposure there, which is about 21% of their loan portfolio. That is the largest of any major bank in the industry. So again, they have very large exposure to some of the areas that people are worried about. All right, next this is capital. Banks have been very well capitalized, and they've been buying back a lot of stock as a result of it. They're also likely to get capital relief next year from changes in what we call the Basel III rules and the G-SIB surcharge rules. But that's next year, not right now. But in the first quarter, banks spent a lot of their capital on buybacks and supporting their clients. There was good loan demand, and prime brokerage really took off. I mean, it's been strong for a while, but it really took off. So the excess capital was depleted in the first quarter for most of these banks. If you look over to the very, very right-hand column, I show the Wells Fargo's excess capital expressed as a percentage of their market cap, and it's only 0.2%. So they've spent their excess capital. So as a result, I'm expecting that their share buyback programs will slow. If you go to the last table, this actually shows the salmon colored column is their first quarter share buybacks, and you can see they bought back 4 billion in the first quarter, down from 5 billion in the fourth quarter. They've had a very robust share buyback program. They've been buying back about 7% of their stock, but they've peaked out. Wells Fargo was the only bank in the first quarter to buy less stock than they did in the fourth quarter. And I think for the full year of 25, I'm confident for the full year of 25, they'll buy less stock in 25 than they did in 26. So they've spent their capital. Their buyback program is going to slow, albeit still robust. So I don't want to, nick them too much. Anyway, so Wells Fargo is one that I think, if you look at the stock price, it broke below its 200-day moving average, on their poor earnings, and we'll see if it can recover it. But so far, it's staying below it.
Okay.
So name to sell and aggressive traders to short.
Okay. And Citi, you still like long, it sounds like. And if you want to pair trade, you could pair Citi with Citi long with a Wells short.
Yeah, Citi remains, my number one pick. If you look at, in the world of Robert and Marson, maybe Flagstar.
I was going to say, and if you like the small caps, which have been on a roll lately, you like the Flagstar. All right, Mr. Marson, thanks for being patient. Great recap, Charlie. That was excellent.
I have a question.
If you want to see those slides, I'm sure Charlie will put them up on the.
I have a question for Charlie.
Sure.
Go for it.
So, Charlie, if I bought banks, I would follow your advice religiously, but I don't. So I can't use your expertise for my financial benefit. However, I am wondering if the recent rally and recovery to new all-time highs in all the major indices suggest that your macro concerns could be eased up a little bit in here with the recession and the potentially a housing market decline of significance in prices and the stock market decline. Do you think anything's changed now that sort of we seem to have dismissed the effects of the oil price and Iranian war?
I'm very skeptical of the rally. I think it's driven more by flows than it is a referendum on fundamentals or the Iranian, war being resolved. Anyone who came into that Iranian peace deal was probably either hedged, short, or underinvested, and they're having to scramble to change that mix. You add on top of that, the option market makers now have to chase, they're reversing their positions, and the CTAs. I think Goldman put out that the CTAs have 40 billion to buy. So they went from net sellers 2 weeks ago to big buyers last week, another 40 billion to buy this week. So I think flows are making more of a difference than any sort of fundamental, assessment. But I will admit, I've seen virtuous cycles start with big stock rallies. And, big stock rallies lead to greater confidence leads to more spending leads to, stronger GDP. So, I don't want to dismiss this rally as potentially sparking something more fundamental. But if you look at the rate structure, it still works against you. If you look at oil prices, they still work against you. But, the consumer, that was the one thing that came out, in all the commentary, in the bank earnings season, was that the consumer still remains very, very resilient, even in the month of March. Although much of the spending was, related to gasoline. But, they said they're still spending on entertainment and other, discretionary items.
Yeah, and today's retail sales number looked good. 1.7.
Yeah, I wanted to see what
expectation was 0.6. What's that?
I wanted to see what pending home sales data did. I didn't get a chance to look at that. That came out at 10 o'clock.
I didn't get that one.
I think it was up 1.5%, is if what I'm looking at is correct. So that's not bad. And DHI, I don't know if anyone can put that up on their screen, but DHI reported yesterday, and they had numbers that were soft, but the stock was up like 9 or 10% this morning. DHI is DH Horton, sorry.
Yep. Have you guys been following the Avis short squeeze?
I have.
Is that unbelievable or what?
It really is. I mean, it's probably the primary reason for the transport index doing so well.
100%, 100%. Phenomenal. Having flashbacks to Volkswagen and a long time ago. I'm showing my age.
All right, meme stocks have been on fire. I mean, and that's what, that's the other thing that makes me a little bit skeptical about, this rally. But listen, could this market go, S&P go to 7,400, 7,500, 70? Yeah, I think it could.
Sure. Yeah.
It definitely has a lot of momentum, that's for sure. And a bunch of momentum indicators that I follow via a guy named Ryan Dietrich, who posts on Twitter a lot, suggests that if you hit an all-time high in April, 18 and 19 years with an 18% average return. Now that's for year to date, so you've already chewed some of that up. And if you've had a 7-day consecutive S&P win streak, similar numbers, 18 to 19 years and up 19%. So the other thing that concerns me is a guy who's trying to put cash into a dip that didn't buy that. I sold the rally, didn't buy the dip because I didn't think it was dippy enough for me. I think
a lot of people had that problem.
The idea that, I can still buy a lot back at lower prices, but other ones have doubled since. They'll never get back into Arteris AIP at 24, buddy. Anyway, but that happens. The idea that we're going to have a second correction or a bear market after having a correction and an all-time high in between. I asked, ChatGPT to look that up for me, and I think 1987 might be the only year in history where we had a correction and a bear market, or a correction, an all-time high and a correction. So it's not common to have two distinct downturns in one calendar year.
So, but you got the midterms this year. You've got, gas prices inflation's higher. I don't know.
This
could catch up to us at the back half.
In the midterm election cycle, the dip is typically twice the dip of the average drawdown. Is my definition of dip, is twice the average drawdown of any other presidential year, and it typically happens in the third or fourth quarter. So I wasn't buying the first dip because I didn't think we'd get to all-time highs in a recovery. I thought we'd meander around, consolidate, and maybe have a second leg down in the fall. So I was just waiting for time to pass. But as I said, it's not very common to have two full-blown corrections or a correction in the bear market one calendar year. So I don't know if we're going to get a chance to buy stocks a lot cheaper. So I'm just going to sit on my cash, for the most part, until the next correction comes. I'll be looking more for shorts. And Wells Fargo is an interesting short, 20%. I'm looking at shorts that have squeezes, that have companies. There's a company, AXTI is a ticker. It's a company that makes indium phosphide substrates for semiconductor chips and lasers. And it's a shitty business. There's 8 people in it. So half of them are Chinese. There's Japanese. The stock was 2 and change 13 months ago, and it closed at 85 2 days ago. It has $19 million or $20 million in quarterly revenue, which is less than they had 10 years ago, to tell you how bad the business has been historically. And it had a $4.5 billion market cap on $80 million revenue run rate 2 days ago. They thought so much of the stock price, they sold stock at 12 when it had rallied, and then they just sold stock at 64 when it had closed at 84. They sold $600 million worth of stock at that valuation. Wow. So that's how insane this is. Trading at 60 times revenues, not 60 times earnings. So if they quadruple their sales, they're in 3 or 4 years, which is impossible in my opinion. They're going to be at 10 times sales, and 10 times sales with a 10% net profit margin means they'll be at 100 times earnings when the business quadruples. That's pretty crazy shit. So
Right.
that's what we're
that-
in this kind of
your
market.
meme. That's your meme stock analogy right there.
That's a meme stock today. Yes. So, well, we all see where AMC is recently. I think it got to 80 cents or something. So it was, it was a meme stock at one point too. Yeah. My son gave me crap for making him sell it with a profit. So he sold it in the 20s or 30s with a profit. It went up more and he was yelling at me. So I said, see, anyway, in the long run, the market's a weighing machine and businesses will get fairly valued. It's can you stay short long enough until that happens? That's the $1 million question. But I do have a couple of stocks to talk about.
Can you get a borrow on AXPI, Robert? Can you short it?
I haven't even tried yet.
You haven't tried?
So,
okay.
Well, it closed at 84, and the rule of thumb is when you break 80, you run to 100. So I was holding out for 100. I was called at like 98, 99. I was going to put a short, for a few thousand shares, just to have something exposed. But anyway. I'm going to mention a couple of names. One I would buy. One is cheap, but I wouldn't buy it because I don't trust it. And even as a long, I didn't trust it. So if you take a peek at Crocs, because the consumer seems to be okay, Crocs has had a nice little rally. I didn't buy it in the 80s. I didn't buy it when it crapped out after I bought it at 100 on the way down from 150. But it's a cheap stock, and there is buzz about sales starting to pick up for the first time since I owned it. Because honestly, for 2 years, their sales have been crappy, mediocre at best. And they've done a poor job exploiting their lack of market share in the international markets, unlike Skechers, because they didn't want to invest. They wanted to buy a lot of stock back. And they made a bad acquisition, and they're still digesting that acquisition. So in my opinion, it's still a very cheap stock. And if the business has turned the way Goldman and a couple of other brokerage firms have reported, maybe there's some follow through, but it's still very cheap if they do this year's numbers. So people can take a look at that. I have a starter position. It never got real, and I don't think it'll ever get real. That's just the way it is with this stock for me. And then the second stock.
Anecdotally, Robert, I can tell you the teenage kids have stopped wearing them. And the younger kids, kind of teenage elementary school kids, I don't see them as much on them anymore. They used to wear them before their sporting events and swap out their Crocs for their sneakers before the games, and now they're just wearing.
Well, that's not good.
Doesn't matter.
Not good news. So I don't know, right. Sample size of one, but still, it's
a sample size of 2.
It's disconcerting to hear that. Jen, what do you hear on Crocs? Anyway, she has.
I don't think her little one's wearing Crocs yet.
Burn is the one with expertise.
That's right.
Because her daughter's circle is very big fan of Crocs, according to her, and that circle still hasn't dropped the brand. Anyway, it's something to take a look at. Now on the stock that I would buy today, if I didn't own any of it. I'm really getting intrigued with my Koru Medical, the subcutaneous pump drug delivery company, KRMD. I wouldn't go all in, but the stock got down to 4.25 from 660 this year. So it's at its 1/3 decline, and it's not screaming cheap the way I like them, but nothing growing today is cheap. But here's the opportunity as I see it. It's about a $200 million or $190 million enterprise value at 4.25. And the street, they did 41 million in sales last year. And the street is 48 million for this year and 57 for next year, right? And that's solid growth, 18%, right? Yeah. If they did that, I'd want to fire the CEO, okay? Because I'm at 51 or 52 this year and then 63 next year. So the delta is I'm at 25% revenue growth compounded for 2 years. The street's at 17.8%. And if they make my numbers, there's a triple discount in this company, theoretically, I don't know this for a fact, but I can imagine this is the scenario. They have an aspirational goal that should be at least 25% in my mind. And then they have a budget that should be a couple of points below that. And then they have what they, would guide to, which is a few points below that. And then there's what the street analysts put out, which is a couple points below that. And that's how you get the delta between 18% and 25%. So
Yep.
if they do 18% a year, the stock will work from here. It's 2.8 times, 2.9 times next year's revenues. I've been complaining to you pre-show that there are stocks out there at 30, 40, 50 times sales when they get memed up. And then there's companies I bought like Arteris at 2 times sales, and I sold it at 6 times sales. And now it's 13 times sales, so it doubled again, okay? So, and Arteris is growing revenues 10% a year per share, okay? This company is going to grow 25%. It's in a med device business. People don't think of med tech or med device companies having 25% organic revenue growth. So perhaps they don't know how to value it. But if this company made a widget that went into data centers, it would be trading, it would be with those growth rates, it would be trading at 30 times sales, not 3 or 20 times sales. So I'm in this in the low 2s. I didn't sell a share at 660 because to use a phrase someone pitched to me when I asked her on this show about shorting pool, it's my best growth compounder, which I guess means you sit back and compound and there's no worries. The stock's dropped 40% since then, by the way, but still. So my compounder, which I don't want to ever sell because I'm going to be forced to sell this because they're going to sell the company to J&J or to Becton Dickinson. Whether it's 3 years or 7 years, I don't know. But I won't have the luxury of holding this for a decade, I would guess. But that said, this business, the subcutaneous delivery of drugs is far better and easier and cheaper than doing IVs in hospitals. And there's just a huge shift going on from liquid drugs. They used to call them IV drugs, but now they're not IV only because they have subcutaneous. So you can't say IV. It just means a liquid drug, a drug in a liquid form that goes through a tube and a needle via pump into your belly. And these things take 30 minutes when an IV takes 3 hours. And if you're in an infusion center, you could, instead of doing one manually, you could do 2 or 3 and oversee the pumps once you set them up. So you could do that with IVs too. You can multitask. A nurse could have multiple IVs running at once, but it's still 1/6 the time. So imagine the revenue that if you're getting cancer treatments or if you're getting any kind of drug that requires this kind of volume and time to deliver it via an IV, this is far superior. And the industry is only a few $100 million in revenues globally, maybe 400, I think, right now. They only have like 6 or 7 drugs. They have 15 drugs coming in the next 2 to 3 years. So if they can't triple revenues in 5 years from last year's revenue base, they should be embarrassed, in my opinion. So it's a high growth business. It's nice margins. There's a consumable aspect to it because once you get on these pumps, a lot of people stay on them for a long time for these delivery systems. So they have the disposable part, the consumable part is the tubing and the needles. You don't reuse them. You throw them out. So this is just a phenomenal business. And the stock's the same price it was 10 years ago at 4. It's ridiculous that it trades at these valuations in this market for their financial characteristics. So down at 4.25. If I didn't own a position, I would start one. I didn't sell a share, but it's one of my larger positions. But down here, I'm very interested in adding to the position if it gets any cheaper from here, even though it's already a large position for me.
So is it just it's not getting institutional interest? Is that just because it hasn't done much other places to put kind of dead money? That's what how an institution would look at it.
I think it's fair to say it had to grow into its triple from last year's low of 2, right? It went from 2 to 660. and that was clearly an overshoot, right? But now at 4.25, you're back to fairly priced for a normal market, but you're actually cheap for a 25% organic revenue grower in this market. You're very cheap, in my opinion. So, it's just a matter of that. It's just every year they sandbag in their guidance for the year, and the stock takes it literally. There's for a company, there's a lot of solid coverage in the second and third tier brokerage firm. So no, they don't lack coverage. They don't lack sponsorship. It's just that a story is it's not very known, and they have to get out and do more conferences and tell the story. In my opinion, more than they do. They do a few presentations a year. They need to triple that, in my opinion, to raise the awareness. So,
all right. Well,
I missed at the beginning. What was the symbol?
KRMD.
KRMD. Okay.
Yeah.
Yeah, he's had this one on his list. Since we started this show, 2.5 years ago. Yeah.
Yep. Yeah, but it's my compounder. It's on autopilot.
Yep.
Well, I don't put anything on autopilot, and honestly, I was thinking about this. I don't, much to my disappointment and net worth. I don't think I've ever held a stock for longer than 4 years in my life, 3 to 4 years. And when I've turned
this one is the exception.
And we'll see. Hopefully I've got it right. I've turned a lot of 20 baggers into 5 baggers and 6 baggers in the last 5 years.
Well, nobody lost money with a 5-bagger, Robert. All right. So before we sign off, we got to address the elephant in the room, which is, let's start with the hat, but even more so the shirt. What's going on here, Robert?
Oh, the shirt.
Besides you're a Philadelphia Flyers fan.
Is Gritty, the Flyers mascot, and he's an obnoxious, charming asshole mascot, and that's what Philly loves, just like me. And the Flyers, I'm very bullish on the Flyers. They're 2-0.
Okay.
They beat Pittsburgh in Pittsburgh, and to get into the playoffs, about 8 weeks ago, the Flyers had, according to Money Puck, had a 3.8% chance of making the playoffs, right? We had to win 70% of our games. And with 20 games left, no team in NHL history has ever made the playoffs as far behind as we were in the playoff race. 60 out of the season's 80 games. So the season was 3 quarters through, 1 quarter left. So we entered the playoffs on a roll, and we just went into Pittsburgh and kicked the pants off of them. 2 games, beat them decisively both times. And I'm just very bullish and very long the Philadelphia Flyers. So if you're a betting man and there's some good odds on the Flyers.
I was going to say, how much money do you have right on this?
I thought about it, and usually every year I make a $500 long shot bet on a Philly team, winning something. And whether it's the Phillies on the World Series or the Eagles in the Super Bowl, but I just didn't buy the fact that they were going to make history to make the playoffs. So I never made a bet, but I'll look at the odds tonight and see if it's worth a couple $100 as a fun bet.
I suffered the opposite indignity. The Bruins were up 2-0 over the Buffalo Sabres with 7 minutes to go in the third quarter, and they lost 4-3.
Yes, they gave up 3 goals in 3 minutes. It was
That's hard to do.
Yeah, but NHL playoffs are fun, so it's a good time of year.
For sure. Well, we love the shirt. And the hat's nice too, but that shirt is something else. I'd give you props for that. All right, everybody. Thanks for joining us on Wall Street Beats. We got a Wells short, we got a Koru Medical Care MD long, we got a Flagstar long, and we got a City long. Those were the ideas for the day. Go make some money. We'll see you back here tomorrow. Have a good one.
Thanks, guys.
Thanks, guys. Thanks, Steve. Thanks,
Robert.
Guys. Thanks, Jen.